Yeah, welcome back again. This is part 7 of our lecture on inheritance tax, and today there will be some first remarks on the tax base. So we are still in chapter 2, giving an introduction to German inheritance tax law that you can have a relatively precise idea of how at least one example of an inheritance tax works. Yeah, so due for today are some information about sorry, the arisal of the tax and the tax base first steps. The arisal of the tax means nothing else than the date on which the tax liability begins to exist. That date is in most cases relevant for the question how the value of the property in question has to be determined, because when you have to value something, well, the value, prices, and so on of things vary over time. So you must know which point of time is decisive for the valuation. And that is what is mostly combined with the arisal of the tax. Example, your father owns a villa and has the villa, a value of 20 million euro. Now on the 23rd of October at 20 in the evening till 8 p.m. the villa begins to burn down. Half of the villa has already burned down at 20:38. At this moment, your father, who has only just noticed the fire, tries to run out of the building, is unfortunately hit by a brick falling down from the roof. The roof is gone and father is gone. Father dies immediately. So 2039, you are now, as only child and heir, the possessor and owner of the house. Now, after 2039, the house goes on burning and burns down nearly completely. The ugly remains which survive the fire now only have a value of 500,000 euro. To make the disaster complete, the house was not insured against fire, so that's it. Now, you evidently inherited a house, but when it comes to finding the value for the house, you have now a choice. At 20 o'clock in the evening, so at 8 p.m., the house was still perfect, 20 million. When father died, it had only half of the value remaining, or would it be correct to take into account the value of the house after it completely burned down? So would the events after you took it over, after you inherited it, still influence the value of the house? That I do not know. Well, these things not happen in practice, but the thing is, we would need a criterion to decide things like that, and so you need the arisal of the tax. It must be fixed. And then the law says, well, look to the arisal of the tax for valuation, usually. So if we strictly follow that principle, probably you inherited a house with a value of 10 million. Although otherwise, you could probably argue what's the value, market value of a house which is currently on fire. Then you come probably, by debating about what the right market price is, to another valuation. Good. But as you see from the example, the point of time is really extremely relevant and important for the valuation. Good. So the arisal of the tax is regulated simply in paragraph 9 of the Inheritance Tax Act in Germany, and that makes sense to place it here before we begin with the determination of the tax base, because you must already know the arisal of the tax, so the date which counts for most valuation processes, before you begin calculating the tax base. For the tax base, we have general rules and rules on more specific cases. The general rule about the tax base in German law is that the tax base is the enrichment of the acquirer as far as it is not tax-free. So paragraph 10, first sentence in the first paragraph. So what is the taxable amount depends on what the recipient gets and not what it costs the donor or the deceased. That might make a difference, especially in situations where somebody gives you a gift, and to make that gift causes additional costs. For example, you need to go to a notary in order to make a house as a gift or so. Then having to pay for the notary doesn't bring along an additional enrichment for the acquirer. So only the value of what has been passed on counts. This makes sense because you know there were two different types of taxes, the estate tax and the inheritance tax in the stricter sense. And the inheritance tax was a tax where the rule was we tax that what the individual heir or donee gets. So here it would be clear that this fits in. If we decided for the perspective, well, we want to tax what every single recipient gets, then it makes sense to ask what these people get and not if there are additional costs on top. Well, in case of an acquisition on grounds of death, the enrichment of the acquirer is the value of the whole taxable property minus the liabilities. So the positive minus the negative elements of the inheritance of the estate. Makes sense. If you have, let's say, 3 or 4 heirs, then naturally everybody inherits his own percentage of everything which is positive and everything which is negative, so that doesn't change anything. Good. Liabilities, which can lower the acquired property, can be the debts of the deceased. Because you know, if somebody dies, you take over all his positive and negative items of property. So the liabilities also are inherited by you if you inherit. And so your enrichment is only the net difference between the assets which you get and the liabilities which you have to take over. So the liabilities are naturally deducted from the value of the assets. The only thing which is left out of consideration here is the business liabilities, because due to special procedures, a business is valued as a whole. So already when a business is valued, the business assets and the business liabilities are taken into account together. That is the reason, and the only reason why business liabilities can't deduct it at this point of the calculation. The reason is, under German law, they have already been taken into account at an earlier stage of events. Well, now there can also arise obligations from inheritance. You remember, when you are the heir and there is a testament which establishes some legacies, then you as the heir have the obligation to pay out the legacies or fulfill the legacies. It might be that there are also conditions to be fulfilled and so on, which under the testament you have to do. The monetary value of these obligations can be deducted. So a legacy will be taxed in the hands of the person who gets it. The person who has to hand it over naturally is less enriched, so they can deduct it as a liability. Then, if you are the heir of somebody, you usually have, I believe even under the legal aspect, the duty to, as we in Germany say, bring that person under the earth. So to organize the funeral, and what's the financial point in that, to pay for it. So if there is an heir, and that heir didn't reject the inheritance, in all probability, the authorities, the undertaker, or whoever will approach these people for payment of the funeral costs. So funeral costs are also an unavoidable liability for people who inherit, and so they can be deducted from an inheritance. Now, the cost of the funeral can be proven just by invoices and receipts and so on, and individually with the actual amount be deducted from the taxable inheritance. Now, that's not always easy, because then the fiscal authorities will check the costs and they will probably start a debate if the funeral costs were not unnecessarily high. So things like we accept paying for a funeral, but combining it with a mega party is probably not adequate. So you would either have to argue with them if your costs were adequate, or you can also renounce on individual proofs, and then automatically, if there is no other information or no information about higher costs, then it will be deducted a lump sum of 10,300 euro for the funeral costs. Now you will probably think, why 10,300? These Germans are always so exact in their in their estimates of the funeral costs. They do not even say this is approximately 10,000, this is approximately 10,300. Well, that's not the German mentality, indeed, but the explanation is that was originally 20,000 Deutsche Mark. And when there was the currency change from the Deutsche Mark to the euro, the Germans were very, very nervous that the currency change could be used by the fiscal authorities to cheat the population, to reduce silently and undercover free allowances and other things. So whenever something had to be transformed from a Deutsche Mark amount into a euro amount, the fiscal authorities took great care to round it up. So when you transformed that 20,000 Deutsche Mark into a euro amount, that was not exactly 10,000, but a bit more, evidently. 10,200 and some minor amounts. And so somebody said, okay, then we must round it up, because otherwise there will be a revolution and the population will think, well, we always suspected it. They are going to use the currency change to trick us and to cheat us and to deprive us of long-standing financial advantages. Now, as you see, that currency change happened in the year of 2002. So you see that the costs, which are believed to be, which are believed that one can believe them without proofs for a funeral, were the costs and are still the costs of the year 2000. And well, that 20,000 Deutsche Mark was already old-fashioned and outdated at that point of time. So that has never been adapted to inflation. So it's probably far too low. Well, but if you have a case to solve, then you know, okay, if there is no information about the funeral cost, 10,300 can be deducted from the amount of the inheritance. Naturally, not 10,300 for each individual heir, because if you have 3 children, your father or mother is not entombed into the grave 3 times. So then it must necessarily be distributed. So these are the most interesting liabilities. There is the one or other exclusion. So liabilities cannot be deducted if the liabilities were taken up to finance an asset which was then free of tax. So there might be circumstances where, let's say, a car of the deceased father or mother goes over to you in course of an inheritance tax-free under a free allowance. Now, if that specific asset has then been financed by a bank credit, you are not allowed to deduct then that bank credit from the tax base. Or in international cases, even more important, if you imagine you had a case where you inherit a house abroad which were under unrealistic assumptions, which really were exempted from the German tax base, then the credit by which you finance that house would also automatically be exempt from the tax base. So liabilities not deductible if they refer to assets which were not taxable. And now if you inherit liabilities which your predecessor used for assets which are not taxable because they never used it for assets, then the rule can't logically apply. Because if, let's say, I always took up credits in order to finance my holidays, then these liabilities do not refer to assets which are tax-free or not taxable under this tax act. They refer to simply nothing, which I could inherit, and so the exception should not apply. If that matters for limited tax liability, only individual assets are subjected to taxation, then only those liabilities are deductible which have close connection, an inner one, with these assets. So if you inherit, well, if the taxable event in Germany only covers a house, then you can only deduct the liabilities which refer to that house, nothing else. Not all the liabilities which somebody then has abroad also. The debts of somebody who died include also the tax liabilities which that person left behind at the moment of death. A regular topic here is the income tax final payment. You know the income tax is always due finally at the end of a calendar year, and so you have to hand in a tax declaration at the beginning of next year. And so if Mr. or Mrs. X dies on the 30th of September in the year 01, that doesn't save that person from income tax. You know, two things on earth are safe, death and income tax, but death doesn't help against income tax. You can even die, you still have to pay. In that case, after you died, well, there are certain technical difficulties for you yourself to pay, so the fiscal authorities will approach your heirs and tell them, well, by inheritance, you took over all the assets and liabilities of Mr. X or Mrs. X. So you also took over the liability to fill out a tax declaration form for Mr. X in the name of Mr. X. Send it to us so that we can calculate what, after deduction of all prepayments which were made, Mr. X still owes us. So, or you as legal successor, who inherited all rights and obligations of X. So when in the end it comes out, X still has a final payment to make for year 01 of 2,000 euro. This is a liability which existed and formed part of the estate, so can be deducted. The other way around, by the way, if it comes out that the prepayments made by X were higher than the tax which was owed by X, then you get a refund, and such a refund would also be an asset which was part of the estate. Although in both cases you at the moment of death cannot name the exact amount, you know it's there. It has potentially already existed at the moment of death. It was an unavoidable obligation caused by the existence of X, or it was an undisputable claim, although then the amount was unknown, belonging to the property of X, and so you inherited it. It was present there. It was part of the inheritance of the acquired property. So part of the total enrichment, and so it would have to be taken into account. However, the inheritance tax liability could now become the object of a debate. Father dies, leaves $1 million, Now imagine the result is an inheritance tax on father's estate of 150,000. Probably the wrong amount. I just needed a figure. Now you can have a debate about that. Who is then the person who owes the inheritance tax to the fiscal office? Was that caused by father's death? Yes, and so on. But should father pay it or should I pay? And here the law has to make a decision. And the clear decision of the German law here is the inheritance tax, which is due for that transaction, which is just under discussion. So the inheritance tax on the transfer of, let's say, 1 million amounting to 150,000, that tax is not deductible. So inheritance tax is not deductible from its own tax base. Surprisingly, one could now in an international context debate if when X dies and you also inherit, let's say, a house or a bank account abroad or something like that, and the foreign state takes an inheritance tax, which you have to pay because you are the heir, if that can be deducted. The German wording says the inheritance tax of the acquirer cannot be deducted. One could interpret that in a narrow sense, that the inheritance tax must be one very special definitive one. You could say that means only the German one, because only the German one is called Erbschaftssteuer. But on the other hand, you could also say it refers to a category. The inheritance tax as the total amount of inheritance tax which is due is not deductible. Now, surprise, the courts in Germany always held the opinion and decided accordingly that 10.8 inheritance tax means all inheritance tax liabilities resulting from the transaction in question, so the inland ones and the foreign ones. That means, surprisingly, that if you have to deal with a cross-border case and you have to pay foreign inheritance tax, this cannot be deducted from the tax base. So what you know from the field of income tax as the deduction method, a kind of method to avoid double taxation, which is always a kind of last resort, the last help if anything else exists. This deduction method is not applicable within the German inheritance tax. So it could even happen that if you inherit 1 million and there is a foreign inheritance tax on 600,000 on them, and now unfortunately, due to a very bad constellation of the situation, you cannot use the credit method for the foreign 600,000. Then you can also not deduct that liability from the inherited amount. And now imagine if the German inheritance tax is 500,000, then you have a total inheritance tax of 1.1 million. So 110% might happen. So you are not shielded against this due to the fact that the deduction method is not applicable. By the way, and however, there is another subsection in paragraph 10 where it's regulated what happens if between living persons a donation is made, let's say 200,000 or let's say 2 million. Sounds better. We need a bit of positive things in our minds. So you get a donation of 2 million. Now the interesting thing is who has to pay. Now we have two living persons involved, so it matters who is going to pay the inheritance tax. If, for example, the inheritance tax here is 2 million, no, mine is 400,000, then you get 2 million and you directly have to spend 400,000, so the net remaining amount is 1.6. On the other hand, if father, mother, grandmother, whoever gives you the 2 million says, here you are, you get 2 million and I am willing to pay the inheritance tax on that gift, then that might be considerably different. In such a case, the German law says, okay, now if the donor takes over the obligation to pay the inheritance tax, then virtually you get more. Well, so the donor also then, makes you richer because the donor saves you the amount of inheritance tax. So they said, okay, if 2 million lead to an inheritance tax of 400,000, if you calculate it on that basis, and the donor also places these 400,000 on top, then the total enrichment which you have is 2.4 million. That deviates a bit from the general rules, and so it has been clarified in paragraph 10.2 of the Inheritance Tax Act. This is surprisingly not exact, because if you use exact mathematics, a different amount would come out. That particular problem is addressed in 10.2 of the Inheritance Tax Act. There you find, if the donor takes over the inheritance tax burden, instead of the acquirer, the taxable amount will be calculated in the following way. First, the inheritance tax will be calculated on the transferred amount. Then one adds this inheritance tax up to the transferred amount and says the total enrichment is the total of both, and then the tax is calculated on the grounds of this together. Now the example shows how that would really be done. Imagine the tax rate is 20%, the donation is 2 million, the donor pays the inheritance tax. Then first we say, let's look to 2 million, that would cost 400,000. The donor places this on top, so the donor takes over the additional obligation to pay 400,000. So we say in total the enrichment of the tax base is 2.4 million, and 20% calculated on that amount is 480,000. Now, if the legislators had been more able in mathematics, then they would have known that 20% out of 100% are 25% of the remaining 80%. So 25% of 80%, so 1/4, would have been 500,000. Only then it would not matter who pays. So if the donor takes over the obligation to pay the inheritance tax, this leads in total to a slightly lower inheritance tax burden. Probably the difficulty arises from the fact that the tax rate is progressive, that we have free allowances, and that to find an exact mathematical approach to avoid distortions is probably not easy and would probably exceed the mathematical abilities of nearly everyone in the population and nearly everyone in the fiscal authorities. So that is probably the reason why this can be justified. Yeah, good. Sometimes we have also some evaluation then to decide. When we know after paragraph 10 what is a part of the tax base, so which items count, then we have to decide which values they have. Here, paragraph 11 says usually the value is the value at the moment when the tax arises. So in case of an inheritance, that would be the moment when the previous owner dies. Or in case of a donation, that would usually be the moment when the donation is effectuated, when it's made, so when it's fulfilled. Well, there is a rule, paragraph 12 of the Inheritance Act, which says, usually take the market value. Now that's hidden a bit, because in former times when we had a wealth tax regularly and when we had many other taxes which taxed property, or kinds of property which you held, then there was a special law with a huge collection of valuation rules. That was the valuation law, the Bewertungsgesetz. Now nearly all of these other taxes have been skipped, but the valuation law still survives, like a dinosaur. And so paragraph 12 of the Inheritance Tax Act says, well, for the valuation of property, do what you always should have done. When it comes to the valuation of property, look to the valuation law. And sometimes it says, well, the most important thing is 12.1 of Inheritance Tax Act. It says, in general cases, look to the generally applicable part of the valuation law. That's the, let's say, first 15 or 20 paragraphs in the beginning, which applies to every kind of tax. And there, for example, you find the rule that things have to be valued with their common value. For other special situations, for example, for finding the value of a house or so, there the Inheritance Tax Act then refers you to other passages in the valuation law with rather specific valuation rules. So here we have the common value. That's nice because, well, you know, the English have a commonwealth. There, the Anglo-Saxon nations have a common law, and Germany at least has a common value. The common value is nothing else than the market value. And if you find that name a bit strange, welcome to the club. Nearly nobody in Germany would ever, in a non-legal context, speak of the common value of a car. This is a term which is exclusively and only used by tax people. Every other person is unfamiliar with common value. Common means the value which is common, so which is widespread. In even the zoological sense, the word can be used. The common horse, the common dog, or the common rat, or the common cat. This is the most widespread type of a cat, a rat, or an eagle. No, not eagle, I don't know. A hedgehog. Common hedgehog would also be a denomination in zoology. But the common value, so, is simply the market value, which can be obtained for an asset in its actual real condition under the common circumstances, under the usual common circumstances. So an example would be if you buy a computer, bought it 3 years ago, 1,000 euro, then the common value at the moment is not 1,000 euro, but the common value is the value for that good, that asset in its actual state at the moment. So not the value for a brand new computer of that type, but the value for a 3 years old computer with that damages and being so old-fashioned as it is. Probably only 150 euro. Now, there might be unusual circumstances or personal restrictions. They are not taken into account for the determination of the common value, because only what's the common held view on the market price counts. Now you will not be able to imagine what that might be. So examples for that. Sorry, wrong movie here. Sorry, there was a wrong sequence of slides. X has inherited some jewels, and the market value shall be 20,000. But X had to promise her deceased mother that these jewels have to be always held in high respect and high esteem, and they shall only be worn once a year on Christmas Eve, because that's a family tradition, and that they never may be sold during her lifetime. X now wants to argue that due to these restrictions, these jewels have a far lower use for her utility. Because she can't sell them, then she is only allowed to wear them once in a year. Indeed. So she says this is highly theoretical 20,000. I can't use this stuff. For me, the value is considerably lower. And the answer of the law is, well, these restrictions are only of a personal character. They only affect you. Any other person would say these jewels have a value of 20,000, and it's your own mistake and your own fault if you had accepted such limitations on the disposal or the use of these jewels. They have an objective value of 20,000, that's a common value, and that's it. Otherwise, we would all negotiate or would beg other people to impose us personal restrictions. Y has inherited a house with a swimming pool. Now, unfortunately, Y sits in a wheelchair and has great difficulties to swim. So now Y argues that from his personal perspective, only the house itself has a value, not the swimming pool, because can't use that swimming pool. Now the argument does not count. In the market, the swimming pool would have an additional value that it cannot be used in the personal situation of this precise and individual owner does not lower the market value. So that is meant by personal restrictions and limitations, and unusual circumstances cannot be taken into account. On the other hand, that can also turn out as positive. Imagine Z has, as heir of the late father, also inherited father's vast collection of father's own individual paintings. Father was a painter. Now Z, as a loving child, values these paintings extremely high, has also, here I just add a bit to the example, Z has also continuously posted on Facebook, Instagram, and any other social medium which comes to our mind, that she is of the opinion that father's paintings have a value of at least 10 million, if not 100 million. And it's only the idiocy of these people outside there that the common population, the plebs, doesn't recognize the true value of father's paintings. Now, unfortunately, as I already indicated, that is very much alone with that individual opinion of father's paintings' values. The fact that she openly admitted to the public, my personal opinion is father's paintings have a value between 10 and 100 million, somewhere in between. And you are all idiots that you don't see that. That does not count. Personal conditions. Well, I combine such valuable memories with these paintings. I would never sell them off. And so all that doesn't count. So tax advisor would probably say, yes, you are absolutely right. Yes, this is really a collector's piece. But fortunately, the others don't know it. And the market value is zero because these people outside there always consider father's paintings as rubbish, and so rubbish they are. That would only change if these things begin to be traded, or if you have an art expert who says, or in some cases probably really, which says these paintings have a market value, and we estimate that as being, let's say, 1 million. So unusual and personal circumstances do not count, and so that can also turn out in a positive way. So if the common held view is in the relevant market, everybody says, go away with these paintings, that is rubbish. I probably would have to pay for the waste disposal, so they have a negative value, I don't want them. Then the common value is indeed a zero. Now let's go back to the next slide, which I probably had to add in between, and which I added at the wrong place. Another aspect which I still want to name is there are some rounding rules. For the inheritance tax, there is a rule. The total which remains as taxable amount has to be rounded down in the last step to an amount of full even 100 euro. So that means if you have, for example, a total of 159,718, then you would have to round that down to the next even 100 threshold. That means to 159,700. Or if the total is 160,799, then you would have to round that down to the next even 100 amount, so to 160,700, not 800, because the law here explicitly commands you to round down to the next 100 threshold and not to round to the next, so to the nearest 100 euro threshold. That would happen usually in the outside world, but here in favor of the taxpayer, the law explicitly says you always round down. This shows again that it can be highly important to read the exact wording of law. And naturally, let me add that little warning, when you work with a translation like we do with my translations even, who are not very linguistic examples of a high genius, but rather rubbish and rough approximations, then naturally when you work with a translation and the wording is so important, when you have the idea that the wording could implicate or better imply certain conclusions, then naturally go and ask a native speaker or a law expert who is a native speaker if you are right in the supposition that this expression can be interpreted in the way which you suppose. Otherwise, there would be high risk. Okay, so now let's go back to the example which I wanted to show you. The things which we have already now dealt with enable us to form a first rough opinion about how a case can be dealt with. Imagine parent P dies and leaves everything to daughter D. Both lived in the inland. P left behind a house and a bank account and nothing else, just to simplify our lives. That many thanks to P to die nearly without property. Now let's begin the case solution. That D inherited from P is a taxable event 1 number 1 because it is an acquisition on grounds of death in inheritance case 3 number 1. The event will be taxed under the rules of unlimited tax liability because P lived in the inland, or alternatively you could say D lives in the inland. See paragraph 2 number 1 letter A of the inheritance tax. The tax arisal is the next definitive step, and that happens on the day of P's death. At the moment when P dies, the tax comes into being. Paragraph 9 number 1, and the tax base is now defined as the enrichment of D as far as it is not tax-free. 10.1 sentence 1, and so we have everything minus liabilities. That means what have we here? The value of the house 200,000. In paragraph 12, that would be paragraph 12.3, which points out which part of the valuation law you would have to use, and here it's given 200,000 is the outcome. Plus the bank account that is to be valued naturally with the nominal value. Money is to be valued with the amount of money, which is, I think, plain and clear everywhere all over the world. 15,713. Now what we now tend to forget is to deduct the liabilities, and if somebody dies there is always at least one liability, even if it has not been mentioned in the text: the funeral costs. So we can deduct 10,300 and we arrive at a subtotal of 205,413. Next step would be we deduct free allowances. There will be a mass of them in that parent-daughter relationship. But if they were not, or if we had already deducted all them, then the last step would be, naturally, we have to round down the result to an even 100 euro amount. So last remarks which I want to make is, apart from the usual things, there might also be some complicated transactions or complicated elements which pose some difficulties for the valuation. First, you might inherit something or take over a liability which is subject to a condition. So you only inherit father's car if daughter, your sister, doesn't manage to make a driver license within the next 2 years. Or you have to pay something under the condition that a former employee retires and can find or decides to retire. So if that employee doesn't retire, or as long as that doesn't happen, you have no obligation. But if so, then you have. Or what else? There are different possibilities. Or what also might happen is you have an obligation or a right which regularly can be used, or a financial payment which regularly flows or has to be made, but for several times. For example, you have to pay a certain amount for, let's say, 14 years every month. Or you have to pay for somebody a lifelong pension, or you have to make a payment lifelong, or you have the right to receive it. All that poses problems for the valuation, because then you have to make assumptions and some decisions. The first thing is you have these conditional things, where a condition is included. How does the thing with the conditions work? Well, if you get something only under a condition, then there are two cases which you can imagine. First thing is you only acquire it if a certain condition is first fulfilled. So that means as long as the condition is not fulfilled, you have nothing. The law draws the consequence: as long when you have not fulfilled the condition, you have nothing. So only if and when this condition is fulfilled, the asset in question or so will be regarded as yours, because as long as the condition is not fulfilled, it's not yours. It can be that retroactively then the tax notice must be changed. Now, after you fulfilled the condition or something else fulfilled the condition, it's clear that you get it. On the other hand, or let's make an example, your parents go to a notary and make a contract and promise you that they give you a donation of 50,000 euro under the condition that you manage to pass your bachelor exam with at least a 2.0 or better grade. Up to now, there is no taxable donation, because the donation is dependent on a condition, and the condition has not yet been fulfilled. When it is fulfilled and when the 50,000 pass over, then tax will become due. Then we have a taxable event. But until then, there's nothing. And it might even be that you never fulfill that condition. There is also another type of condition. It might be that you acquire something, it is yours until a certain condition is fulfilled by you or by somebody else. Then you have to give it away. This is sometimes called a dissolving condition. It dissolves the underlying right if the condition is fulfilled. Such a dissolving condition also is questionable. You never know if it ever will be fulfilled. So here the truth is, or the objective reality is, that you can enjoy ownership of that asset, or that you have that liability. That would be hard. as long as the condition is not fulfilled. And so the law says, yes, there is the asset, you were enriched by the asset, as long as the condition is not fulfilled. And at the moment when we write the tax notice, it is not yet fulfilled, so we do not take it into account. Or there might be a liability. You have to pay an amount of 300,000 over to your sister, but only under the condition that your sister, who regularly takes part in the lottery, does not win 1 million or more in the lottery. Then it's clear you have an obligation of 300,000. You will have to fulfill it. Okay, there is a small chance to get out of it. If sister wins 1 million in the lottery, then you can claim your 300,000 back. The law would then say, okay, let's look to the facts. As long as the condition is not fulfilled, you have a liability of 300,000 which you must fulfill, so you can deduct it from the amount of inheritance. And only if the condition is fulfilled, we could debate about a later change of the tax notice, where the liability would then be cancelled. What might even happen realistically in practice is the parents of your spouse say, we donate a house to you, 300,000 as a present, but under the condition that you and your spouse never get divorced. Okay, as long as you have not got divorced, you can enjoy the house, so there has been a donation, you have become richer, so you have taxes. Now, when there is a big quarrel and somebody says the bad word divorce, and then the divorce really happens, then the condition has been fulfilled. You lose the house and the house has to be given back to your parents. Then the donation has been cancelled by fulfillment of the dissolving condition. So from that moment on, reality has changed, and retroactively we find out, okay, you have not got the house, because if the condition was triggered, fulfilled, then you lost the house, then you never had a right to the house, so you had to get it back because the condition was violated. You only got the house under the condition that you never get divorced. So the common trick is, or the common idea is, if something exists until a condition will get fulfilled, then it exists at the moment when you write the tax notice, so you take it into consideration. You take it into account, it counts. If something, on the other hand, only begins to exist, when in the future a condition will be fulfilled, then it does not yet exist at the moment when you write this tax notice, so it will be ignored. And if the condition will be fulfilled, then things change, and so that might be a reason to change a tax notice. Yeah, some valuation rules. Still, you might have monetary claims and monetary obligations to be valued with the nominal value. Then you might have special circumstances, for example, a claim 100,000 but with 20% interest that would have a higher market value. It might be that you have a claim but it can never be collected because the person who is indebted is bankrupt, then it would be worthless. Okay. But the principle is monetary claims, nominal value. If things are only due in the future and do not give interest in the meantime, then they have to be discounted. The legal interest rate has been fixed to avoid debates, has been fixed in Germany with 5.5%. This is for the last 20 years already far too high, although it nevertheless still remains the mandatory legal interest rate wherever nothing else has been stated in the law. You know, this is a general rule. When there is a special rule, there is a deviation. You have also rules which deal with the problem that somebody might get a lifelong payment from you, or that you have a right to a lifelong payment, or that you have the right to a lifelong service or so, which has a monetary value. For example, you have the right to use a house lifelong free of rent payments. This is naturally something which has an enormous monetary value, so the problem is how can we value that? And the rule for such things is the value for 1 year is taken times the remaining life expectancy and then discounted with the legal rate of 5.5%. So for example, if I have a right to use a house free of rent for the rest of my life, then one would first determine what is the amount of rent which normally I would have to pay, let's say 15,000 euro. Then I have a right to a free service in the value of 15,000 year after year for the rest of my life. So I have to make an estimate how long will the rest of my life be and how much does this add up if we discount all these future advantages over time. What is now the market value of such a right to use that house lifelong for free? Naturally, you can't ask people for their exact life expectancy. We don't want to know and we can't know. So statistics must help, and the ministry usually publishes year after year based on a statistics the remaining life expectancy for people of a given age and how much that means for the present value of an annual amount of €1 which they receive for the rest of their lives. So you can then easily calculate these things. My idea to illustrate that was the rich business owner BO dies and leaves behind complete property to his sole child, so child SC. However, BO obliges his heir or heiress to pay a lifelong monthly pension of €1,000 to the faithful former servant, FFS. FFS is at the moment now 68 years old and has now to get from SC a lifelong pension for the rest of his life. How has this obligation to be treated? Well, SC has inherited everything from father, but has, arising from the testament, a liability from a legacy. 10.5 number 2 says we can deduct that from the total enrichment because that is money which I cannot keep. I have to pass it on. That this has to happen in the course of time, over time, doesn't matter. It has a market value, this liability. So we need to value that. The rules of the valuation law count because there is nothing special in the Inheritance Tax Act for the valuation of lifelong pensions. So we look there, and there we find section 14.1 of the valuation law, which says the annual payment which has to be made is €12,000. It has to be looked up in an official table published by a ministry with reference to 14 valuation law. What is in the year of 2021, so this year, the remaining life expectancy statistically determined of a person, a man with an age of 68, and that says, well, if you are 68 at the moment, you have statistically a life expectancy of 15.78 years still remaining, so you will probably die between you are 83 and 84. And now that means you will approximately receive 15.78 times 12,000. But now this will have to be depreciated. Discounted. That will have to be discounted because, well, the last payments you will only get in 15 or 16 years. And so they do not have the same market value as 12,000 immediately now. So you have to discount that series of payments over time. And so there is a factor given in the table which says 10.656 is the discounting factor for this series of 15.78 payments of 12,000 over this period with a rate of 5.5%. So The value of the legacy will be 12,000 per year, taken times multiplied by 10,656. So we find out that the market value of that pension is now 127,872 under the rules of the valuation law. So that is the amount which SC can deduct as liability from a legacy under 10.5 number 2. Here I just made you a copy of that table issued for 2021 by the ministry, which says, okay, here are the calculation data necessary to calculate the market value of a lifelong annual advantage or obligation in the value of €1 or €1,000 or so. I naturally only took out or selected here that part of the table which is relevant for our person with 68 years. Yeah. By the way, naturally, as we now know that the pension has a market value of 170,085 or so too, then we naturally also can say that FFS, the former faithful servant, has also a taxable event because getting a legacy is an acquisition on grounds of death. The faithful servant has residence in the inland, so there is unlimited tax liability. No discussion if it's inland property or not is necessary. And the enrichment of FFS will be the tax base. So we take into account everything which FFS gets. Here, the pension with a market value of 127,872 minus, if they exist, free allowances, and then what remains after deduction of all free allowances and possible liabilities, then that will be remained, and that will be the tax base. Good, but that is something where we talk about later. And that was what I had as first remark concerning the tax base. We will go on later with the free allowances for persons and with the tax rates. But until then, enjoy the break and come back when the next video comes. Thanks for watching and goodbye.